What's up everyone, this is Coleman here. So today in this video, I'm going to be talking about 3 stocks that I'm buying in the month of May. All 3 of these stocks are stocks that I currently own, and I'll continue to buy if the prices continue to stay low. And at the end, I'll share with you 2 bonus stocks that I might add to my portfolio if the prices and valuations get low enough. If you like this video at any time, hit the like button since it really helps out our channel, and let's get right into it. The first stock I'm buying this month in May is Palantir. Ticker symbol PLTR. So here's basically what's going on with Palantir. Number 1, it's got massive growth potential. 2, they have a great management team. And 3, it operates in a great industry. For those of you that don't know, Palantir is basically a software company that specializes in data and AI, artificial intelligence. They build software that helps companies and governments analyze their data and make better decisions with that data. And this is an industry I really like. Data is obviously an industry that's going to continue to grow in the future, and Palantir is a company on the forefront of that industry. In fact, Cathie Wood actually said in a recent interview that data is the new oil. It basically means that like oil in the past, data is going to be a resource that's going to be very valuable in the future to both companies and governments. And companies and countries that are best able to harness that data and put it to good use are going to have a significant competitive advantage. So I really like the fact that Palantir is a leader in a growing industry, and if you're a company that doesn't use a product like Palantir's in the future, you're probably going to start to fall behind in this new world of data. Recently, Palantir is a stock that's been trading between about $21 and $27 a share, and they have a market cap right around $40 billion. It's a stock that got caught up in the Reddit crowd a few months ago, which is part of the reason that they've fallen from their highs of $45 a share. But there's also been concerns about a lot of the insiders selling their shares once the company went public. But nowadays, I personally don't think insider selling is as big of a deal as it used to be. With a lot of companies, especially private companies these days, a lot of employees receive stock as part of their compensation package. So that's basically the main reason a lot of them choose to sell these days, just because it's part of their compensation structure. Plus, a lot of Palantir's executives have been with the company for 15 plus years, and since the company's been private for almost its whole history, they haven't really had a chance to sell any of this stock that they've accumulated. And now that the company's finally went public, a lot of these employees have finally had the opportunity to take profits and recognize some of these gains they've had on their stock. So I think that's the main reason they've chosen to sell. This company trades at a forward PE of about 164. By no means a cheap company, but the projected growth on Palantir is expected to be huge. For the current year, revenue is expected to grow about 34%, and next year, revenue is expected to grow about 30%. And that's basically the question with Palantir, like how much are they going to grow over the coming years? I know some Palantir investors think they're going to easily beat these 30+% projections and grow well over that into the future. And actually CEO Alex Karp said that their goal is to grow 30+% for the next 5 years. So the projected growth in this company is supposed to just be massive. And because of that, this is a company that I've bought pretty heavily in the past month. Right now, really anything under $25 a share starts to get interesting, but I've been buying mainly around $22.50 a share. That's a price I really like it. If it gets under 20, I'll be buying very heavily, and anything under $15 to $17 a share, I'll be loading the boat. Number 2, and the second stock I'm buying in the month of May, is Alibaba, ticker symbol BABA. So here's basically the situation with Alibaba. Although they're already a large $600+ billion company, the projected growth is supposed to be very strong. Plus, they're a company that's had some big name investors buy their stock recently. And in addition to that, they're also trading at a pretty reasonable valuation with a forward PE of about 23, which is pretty good in this market considering their strong projected future growth. There's just been a lot of negativity around Alibaba in recent months, which is basically the main reason the stock's been down about 25 to 30% from its all-time highs. 1, there's fears that they could be taken off the US stock exchange. 2, there's fears about Chinese government regulation, since they've been recently investigated by the Chinese government for behaving too much like a monopoly. And then 3, their Ant Group IPO fell through, which was a pretty big deal for them about a few months ago. And all 3 reasons have caused the stock to drop, even though that their financials still look good and the projected growth is still expected to be very strong. Now, if you're not too familiar with Alibaba, basically what they are is they're considered the Chinese Amazon. So they have a massive online e-commerce marketplace, and that makes up about 88% of their revenues. So that's the vast majority of their business is their e-commerce online marketplace. They also operate in three other segments. They operate in cloud computing, media, and then they have a segment called innovation initiatives. But by far and away, e-commerce makes up a vast majority of their business, and it's actually the only profitable business segment that they operate in. Although cloud computing is finally starting to become profitable after about 11 years of big losses. And here's why I basically like Alibaba. I think there's two things that people are missing. One, I think a lot of people are missing the fact that cloud is going to start finally becoming another profitable business for Alibaba after all those losses. And two, which is actually what I think is more important, I think people are missing the fact that their e-commerce business should continue to grow well into the future. In China, more and more people are continuing to move up into that middle class, which basically means that Alibaba has a larger group of potential customers every year. Just last month, Charlie Munger, who's Warren Buffett's business partner, just added Alibaba as a new position in his daily journal portfolio, and it now makes up 20% of his entire portfolio. Ray Dalio also added to his position a few months ago, and now it's his sixth largest holding. And Li Lu, who's a fund manager who helps Charlie Munger manage his money, had Alibaba as one of his top positions just recently last year. It's actually a stock that's been my largest holding in the past, so I'm very familiar with Alibaba and I really like the company. I'll continue to monitor the risk of government regulation and potential delisting, but with the price dropping about 25 to 30% and some big name investors jumping into the stock, this is a company that I'll continue to happily buy shares in if the price continues to fall. And as for prices, really anywhere under $230 a share, I'll be a happy buyer of Alibaba stock. The third stock on the list, and then I'll get into a couple of possible buys, is Tattooed Chef, ticker symbol TTCF. So here's basically the deal with Tattooed Chef. They're a plant-based frozen food company, and they're growing like crazy. They sell products like cauliflower mac and cheese, smoothie bowls, and frozen pizza, and the product line continues to expand, and they now have over 62 products. I'm sure you can already see that the plant-based food industry is an industry that's going to continue to grow over the next decade. More and more people are implementing plant-based food into their diets, and some people have already completely made the change to plant-based foods. The industry is actually forecasted to grow about 12% annually from 2020 to 2027. So it's a growing industry, and Tattooed Chef is one of the leaders in that industry. Their revenue's grown 75+% over the past 2 years, and their estimated revenue is expected to grow over 50% this year and 36% next year. So their products are selling like crazy. You can find their products in stores like Walmart, Costco, Sam's Club, and they recently got a deal to sell their products in Target, which is a huge addition for them. And once they're in these stores selling their existing products, they also have plans to expand into areas of food like desserts or even the grocery aisle with products like chips. And with their management team, specifically CEO Sam Galletti and his daughter, Sarah Galletti, who's the chief creative officer, I think they have the opportunity to capture a lot of market share in this growing market. But the stock has suffered a lot of pain recently. After peaking at about $28 a share, it dropped almost 50%, down to $15.50 a share. Some of that was around the time of the whole Wall Street bet situation, so that might have had something to do with the price drop, plus the fact that a lot of high growth stocks have sold off recently. But in addition to that, their CFO had announced that he was going to resign, so that caused a lot of short-term fear in the stock. Even with that drop, it's still trading at a forward PE of about 294. So it's still a highly valued stock, but given Tattooed Chef's growth in the plant-based food industry, I think it's worth the risk reward, which is actually why I decided to open up a position around $16 a share. It's certainly not my biggest position just because I'm not the biggest fan of the food industry. I just think it's kind of a race to the bottom on pricing, plus the margins in the food industry usually aren't that great. That said, this is a company that I do like, and if the price continues to fall, this will probably be a stock I'll continue to add just given the risk reward on this one. I would say it starts to get interesting under $17 a share, but I would be happy adding more shares if it were to fall under $15 sometime this month. Now let's take a look at two bonus stocks that I might consider buying this month, but the price on these companies would have to come down a little bit. The first maybe stock that I would consider buying this month is Baidu, ticker BIDU. Baidu is basically known for being the Google of China. So the core part of their business is the search engine they run, and they actually have the biggest search engine in China. But here's actually why I would be interested in the company. That's not because of their search business. It's actually because they've recently been getting into the electric vehicle industry with autonomous and self-driving software. They recently announced a partnership with Geely, who's Volvo's parent company. So they're taking this electric vehicle space very seriously, even though there's already a ton of competition. Kathy Wood over at ARK Invest actually said recently that Baidu is their highest conviction play in the Chinese electric vehicle market over companies like XPeng and NIO. So there's a lot of potential for them if they were to emerge as the leader in China's electric vehicle market. The stock's fallen over 40% in the past few months, a lot of that being because the electric vehicle market hype has kind of cooled down a little bit. Plus, when the Archegos fund collapsed recently, Baidu was one of those holdings, so they were forced to sell that stock, and that really hurt the price. But I think it's an interesting company around these prices, and like Alibaba, it's another Chinese stock that trades at a really good valuation. The forward PE on this company is about 20, which is actually really attractive when you consider the potential upside of the electric vehicle market that they're getting into. The fact that I would be getting a stable search business, plus the upside of an electric vehicle business, that makes it a really attractive risk reward on this stock. So I think with Baidu, there's basically a lot of upside with not much downside. Now, I don't own any Baidu stock yet, mainly because I'm waiting for the price to come down maybe a little bit more. Plus, I try not to have too much of my portfolio in the China market in case some of these companies were to get delisted or some other unexpected situation were to happen. And finally, the last stock that I'm going to talk about that I put into the maybe category is ST Microelectronics, ticker symbol STM. STM is the largest semiconductor company in Europe, and they specialize in products like sensors and MEMS, which is the reason that I like them. Two of ST Microelectronics' largest customers are Tesla and Apple, and I believe that the automotive industry and the wireless technology industry are going to be both large areas of growth for ST Microelectronics in the coming years. This company trades at a pretty reasonable valuation right now too, with a forward PE right around 25 and a price to sales of 3.5. So it's not a crazy valuation, although I would like to see the price come down a little bit before I would consider buying in. Part of that reason is because the semiconductor industry is very cyclical. That basically means it goes through a lot of periods of ups and downs. And the last thing I'd want to do is overpay and get in while we're nearing the top of one of these cycles. So that's kind of why I'm waiting for the price to come down a little bit before I would consider buying ST Microelectronics. Anyways, those are the 5 companies that I would consider buying this month. Hopefully you found value in this video, and maybe I even shared with you 1 or 2 stocks that you've never heard of before. If you like this video, don't forget to hit the like button. And if you want to see more videos like this, please consider subscribing and hitting the notification bell. Thank you so much for watching, and I'll see you in the next one.